Something unusual is happening in the United States financial markets right now. Not a crash, not a rally, but a quiet pause that every serious investor can feel. It's the kind of moment where the entire market seems to be waiting for one signal, one decision, one announcement that could shift everything. And that signal is coming from one place, the Federal Reserve. Because in today's economy, no force influences markets more directly than the Fed's next move. Interest rates control the cost of money, and the cost of money controls everything from stock prices to business growth to investor behavior. Right now, investors across America are not just watching earnings reports or company news. They are focused on a single question. What will the Federal Reserve do next? Will they cut rates, hold them steady, or keep them higher for longer than expected? And while most people wait for the answer, smart investors are already positioning themselves in advance. To understand this behavior, you need to understand the environment first. Over the past few years, the Federal Reserve aggressively increased interest rates to fight inflation, making borrowing more expensive for businesses and consumers. This shift slowed down economic activity, pressured growth stocks, and changed how money flows through the system. Inflation has started to cool, but it has not disappeared completely, and this creates uncertainty. The economy is no longer in crisis mode, but it is not stable enough for full confidence either. It is stuck in a transition phase, and in financial markets, transition is where the biggest opportunities and risks are created. This is exactly the type of environment where professional investors do not guess the future. They prepare for multiple outcomes. Instead of trying to predict the exact timing of the next Fed decision, smart investors are quietly building flexible strategies. One of the first things they focus on is quality. In uncertain interest rate environments, weak companies with high debt struggle the most because borrowing costs remain high. On the other hand, strong companies with consistent cash flow, stable earnings, and solid balance sheets tend to survive and even grow stronger. So instead of chasing hype or speculative assets, institutional investors slowly shift their focus toward high-quality businesses that can withstand economic pressure. This is not an emotional decision, it is a structural one based on risk management. At the same time, another major shift is happening in the bond market. Many retail investors ignore bonds, but experienced investors know that bond markets often move ahead of the Federal Reserve. When expectations of rate cuts begin to rise, bond prices usually start adjusting before any official announcement is made. That means smart investors are not waiting for confirmation, they are watching expectations and positioning accordingly. This allows them to enter early rather than react late, which is often the difference between average returns and strong long-term performance. Another key strategy being used right now is maintaining liquidity. In simple terms, holding more cash or cash-like assets than usual. This is not about fear or exiting the market completely, it is about flexibility. Because when markets react strongly to Federal Reserve announcements, prices can move quickly in both directions. Those who have liquidity are able to take advantage of sudden opportunities, while those who are fully invested often have no ability to respond. Cash in this environment is not inactivity, it is optionality. It gives investors the freedom to act when others are forced to watch. Alongside this, investors are also carefully rotating sectors within the market. Different industries respond differently to interest rate changes. Growth sectors like technology often perform better when rates eventually decline because future earnings become more valuable. Meanwhile, defensive sectors like healthcare and consumer staples tend to remain stable regardless of economic cycles. Instead of betting everything on one direction, smart investors balance exposure across multiple sectors, ensuring they are not overly dependent on a single outcome. This creates stability in portfolios even when markets become unpredictable. Another important factor being closely monitored is inflation data. Every report on consumer prices, employment, and spending is treated like a signal for the Federal Reserve's next move. If inflation continues to decline steadily, the probability of future rate cuts increases. If inflation remains persistent, the Fed may maintain higher rates for longer. However, experienced investors do not react to one data point. They look for patterns over time because markets move based on trends, not isolated numbers. This allows them to build probability-based strategies instead of emotional reactions.
One of the most powerful techniques used by professional investors during this type of uncertainty is scaling. Instead of investing large amounts at once, They gradually build positions over time. This approach reduces risk and avoids the pressure of perfect timing. If the market moves against them in the short term, they still have capital available to adjust. If it moves in their favor, they already have exposure. This slow and steady approach may not feel exciting, but it is one of the most effective ways to build long-term wealth during uncertain cycles. Risk management also becomes a priority before any major Federal Reserve decision. Many investors reduce leverage, avoid excessive borrowing, and limit exposure to highly volatile positions. This is not because they are pessimistic about the market, but because they understand that uncertainty increases risk. When interest rates are unclear, financial conditions can change quickly, and protecting capital becomes just as important as growing it. Preserving downside protection allows investors to stay in the game no matter how the market moves. But perhaps the most important trait of smart investors during this period is patience. They do not chase every headline. They do not react to every rumor. And they do not make emotional decisions based on short-term volatility. Instead, they understand that the Federal Reserve will continue adjusting policy based on economic conditions, and markets will continue reacting in cycles. Over time, those cycles create both opportunities and setbacks. But the investors who stay disciplined, diversified, and focused on long-term positioning are the ones who consistently navigate these moments successfully. Because in reality, investing is not about predicting every move correctly. It is about being prepared for different outcomes. And right now, as the next Federal Reserve decision approaches, the difference between average investors and smart investors is becoming very clear. Average investors wait for confirmation before acting. Smart investors position themselves so that whatever happens next, they are already ready. And in the world of financial markets, that difference is often what separates uncertainty from opportunity,